Hey there, I am joined today by Daniel Santiago from our team here at the Edge Conference in very hot and humid Boca Raton, Florida. Daniel, you grew up in the ETF industry. You're an ETF native, which means I rely on you for lots of things about ETFs. So thank you. What are some of the hard rules for best execution when advisors are buying ETFs?
Yeah, I don't think we have any hard rules, but definitely tips that we give out to asset allocators. I'd say first thing, avoid trading at the open or close. Second tip of advice, utilize limit orders. It's going to give you more control over the orders that you're placing. And three, get to know the block trading and RFQ, request for quote process.
Okay, so what is block trading? What's the benefit? Why do people care?
Yeah, so block trading is essentially a way for an asset allocator, financial advisor, institutional buyer to go out there and obtain ETF shares at a wholesale cost. So about 50 to 60% of ETF trading actually happens in this way. It happens in the primary markets rather than obtaining or selling the shares on exchange. So investors, asset allocators can work with their custodial block desks to place RFQs to see what the pricing is in the market from various market makers to get more efficient pricing as they are entering and exiting their positions. We would say work with your custodial block desk, whether it's NFS Fidelity, Pershing, Schwab, or you're at a wirehouse or an independent broker dealer. Again, best tip of advice is loop everyone into it. Capital markets professionals, your internal staff, whether it's your trader on your team or the trader at the block desk, your wholesalers, include everyone you can, because we all want to achieve the best outcome, which is ultimately the lowest cost for the investor to get into the product.
For sure. What are some of the common mistakes that people make?
Trading at the open when some of the positions are not yet open, right? So let's say you have a ETF that owns 100 different stocks. Not every stock opens immediately at the open.
Which is weird.
Which is weird. It may open at 902 or 903 or 904. And if you go and place a trade in something that's not open, you may not have the best experience and see a premium in your spread. Another common mistake is not placing a limit order, placing a market order of size into not the most liquid product, right? Another thing to mention is liquidity is not necessarily what is on screen for a product, right? It's really looking under the hood and seeing how fast the market makers can liquidate the positions within the fund. That is actually the liquidity of the product. So I'd say those are two common misconceptions and things to be aware of.
Any other tips?
Stay diligent. Don't think alone. Include us, whether you're working with BlackRock, boutique managers like Taves. We are here to help. At the end of the day, we want to keep costs down and make sure that you and the investors are getting in and out of these products in the most efficient way possible.
Thanks, Daniel.
Awesome. Thanks, Evan.